Okay, if you're a day trader, you know the world of taxes can feel like an absolute minefield. The rules? They're confusing. The risks? They're incredibly high. And it always feels like the IRS is holding all the cards. But what if I told you there's a powerful loophole, a professional structure that lets you sidestep the riskiest rules and finally take back control? Well, today, we're going to break it all down. You see, from a tax perspective, the IRS basically forces you into one of two boxes. Over on one side, you've got the investor. You report everything on Schedule D, which is simple enough, but your deductions are, well, they're almost non-existent. You can pretty much just deduct margin interest. Then, on the other side, you've got the trader. And this seems better because you can potentially write off business expenses. But choosing this path opens up a whole new can of worms. Now, here's what's so crazy about this. The IRS has no specific written tax code that actually defines what a trader is. It all comes down to something called a facts and circumstances test, which usually gets decided in a courtroom. And if you try to claim all your trader expenses on a Schedule C form without any real income to show for it, whoa, that's like waving a giant red flag at the IRS, putting you right at the top of their audit list. So yeah, the standard path for traders is absolutely riddled with traps. Let's dig into two of the biggest ones. A rule that hamstrings you when you lose, and another that can tax you on profits you never even got your hands on. First up, the capital loss limitation. This one is just brutal. Let's say you have a bad year. You can only use your capital losses to cancel out your capital gains. Okay, fair enough. But if you have more losses than gains, you can only write off a tiny $3,000 a year against your other income. So if you have a $30,000 loss, it would take you 10 years, a full decade, to deduct it. And here's why that limitation is such a massive, massive problem. Study after study shows that about 90% of day traders consistently lose money. So for the vast majority of people trying to make this work, this rule means their losses are effectively trapped, giving them almost no real tax relief when they need it most. So you might be thinking, okay, the answer is to officially qualify for trader status with the IRS. But, this isn't just a simple box you check on a form. It is a grueling gauntlet of subjective tests that are incredibly difficult to pass and, honestly, even harder to maintain year after year. To even get the IRS to consider you a trader, you have to meet three core tests. First, your goal has to be short-term profit. We're talking daily market swings, not buying and holding for the long term. Second, you have to show what they call substantial activity. And third, that activity has got to be continuous and regular. So what on earth does substantial even mean? Well, it's not officially written down anywhere, but court cases give us a pretty good idea. They suggest a baseline of at least 750 trades per year. Plus, you need to show that the capital you're trading is significant and that it's a primary source of your income. So trading a $25,000 account on the side while you're working as a doctor, yeah, that's just not going to cut it. Then you've got the continuous and regular test. This means you need to be actively trading on more than 70% of the available trading days in a year. There was a famous court case where a trader made a ton of money in just a few months and decided to take the rest of the year off. The IRS said, nope. In their eyes, a real trading business doesn't just take an 8-month vacation. Now, if you somehow manage to jump through all those hoops, you can make what's called a mark-to-market election. This is a big deal. It lets you treat your trading losses as ordinary losses. That means you can use them to offset your W-2 income, completely bypassing that pesky $3,000 limit. It sounds like the Holy Grail, right? But it has a very dark side. And here is the absolutely crucial point. The mark-to-market rule means the IRS treats all of your open positions as if you sold them for cash on December 31st. So if you're holding a winning stock, you owe taxes on that phantom gain, even if you haven't sold a single share. The cash is not in your bank account, but the tax bill is very real. This brings us to the unrealized gain trap. Just imagine this. Back during the dot-com bubble, traders were holding Qualcomm stock that had just gone to the moon. On paper, they were millionaires on December 31st, and because of their mark-to-market election, they owed massive amounts in taxes. Then the new year hit, and the stock crashed. They were left with a huge tax bill on gains that had completely vanished into thin air. So after hearing about all those traps, you have to be asking, is there a better way? And the answer is yes. Instead of trying to fit into the IRS's broken system, you can create your own professional structure, what we call a family office, that gives you control and deductions, but without all that risk. And the structure is actually surprisingly simple.
You have a Wyoming LLC, which is often chosen for its awesome asset protection and privacy. This LLC holds your brokerage account. Think of it as your trading engine. That LLC is then managed by a C corporation, which acts as your family's management company. The C Corp is where you pay for all your business expenses, your education, your software, your home office, all of it. Let's see how this actually works with some numbers. Let's say your trading LLC makes a $100,000 profit. A portion of that profit, let's say 25%, flows up to the C Corp as a management fee. That 25 grand is what you use to pay all your trading-related expenses. The rest, the other 75 grand, flows directly to you as favorable capital gains, just like a regular investor.
And this C Corp doesn't have to stop at just managing your trading account. It can become the central hub for your entire financial life. It can manage real estate, other investments, and even provide financial education for your family. It really becomes the backbone of your entire wealth building and asset protection strategy.
So what does this new playbook really give you? It's a fundamental shift from being a victim of the IRS's rules to being the CEO of your own financial enterprise. It gives you control, it gives you deductions, and it gives you protection.
So let's just recap the key advantages here. You get to deduct all your ordinary and necessary business expenses through the C Corp without that sky-high audit risk you get with a Schedule C. You completely avoid the dangerous mark-to-market election and that terrifying phantom gain trap. And you're building a professional entity that establishes your trading as a legitimate business, not just a hobby. Ultimately, it all comes down to this one question. Are you going to keep trying to navigate a tax system that's literally stacked against you, or are you going to build a structure that puts you firmly in control of your financial destiny? The choice is yours.